Hello, everyone. Welcome to a brand new episode of One Vision, the FinTech Fuse. Today, Barb and I have a very, very special guest, the one and only Jason Henrichs. Thank you, Jason,
That
for
you've
joining
refused to
us.
have me on this show forever. I've had to beg. Like this has been a bucket list item for years, and yet I had to send you money to get on.
Oh, wait, actually, Barb, we're onto something. We should do this.
Oh, there you go.
We should,
2025 plan
right?
sorted. Thank you, Mr.
2025
Hendricks.
done. For those of you who are listening, no, we didn't actively forget about Jason. It's just that he's too busy going around the globe and trying to tell people how to make banking better and be the fintech philosopher that he is on LinkedIn, which is exactly why he is on the show with us today. Welcome, my friend. Yes, it is long overdue. We'll make this a habit. No, you don't have to pay us, except the first lump sum. Oh, we didn't say that.
Yeah.
All right. So this was a trigger. Your post, the recent post right around Christmas time, was a trigger. You write a very thoughtful piece, as you always do, and talking about 2024 and projecting onto 2025. Let's make banking better. To which I cynically responded, we've been saying that for a decade now, if not more. You remember all those hashtags, make banking better, better banking, all of those. A noble goal, I would say, an old goal of sorts. We did not get there, or did we? And why?
Man, how long do we have? I mean, I think back to when you and I first met, Theo, right? You were running the accelerator program for AARP.
Mm-hmm.
And we talked, and Alloy Labs was just an idea at that point, but it was working with a lot of banks in the post Park Street world around this idea of, digital transformation, innovation strategy. And for as much as we want to put that smear, the digital lipstick on the pig of like what we do for banking and what fintechs promise to do, I think we got caught up in making things prettier and forgetting pretty isn't necessarily better.
What do you think, Barb?
Yes, no?
I, when I think back about what I've sort of seen and been involved in and done and not done, um, oh man, now I've got a song trapped in my head. Thank you. So,
Ooh.
anybody bursting out into some I Feel Pretty West Side Story? No.
Yeah.
Yeah, I think we got focused on how to bring people into our world and forgetting a little bit about that nobody else cares. We're the only ones that care. Like, it's a good thing there's those of us that care about all of these things on everyone's behalf. But yeah, it's not only just does your app look better, does it launch more quickly? I think we forgot that people don't want to be in that app with us.
Yeah. It's one of the things we talk about quite a bit, both as our investment philosophy out of the fund, but especially in the concept lab, right? Which is how we build partnerships between banks and the startups, is this idea, we call it the edge of money, right? Like to your point, it's like people don't want to go into the bank. No one wakes up and goes, oh, I think it'd be fun to get a mortgage saved. I mean, bankers might think about that, but it's part of a broader story arc, right? Like I'm getting married, I'm having kids, the kids are leaving, I'm retiring, I'm moving, I'm buying a second house because I'm thinking about retirement, right? The mortgage is part of a story. And we in banks tend to be in the middle of banking, and we forget that we're a means to an end, right? The Bill Gates quote about people don't need banks, but they need banking. And, I would throw, the wrench at the fintechs too. I think they got caught up in this idea of we can, be a better version of a bank and a digital version of a bank. But I think they also forgot, like, they're a means to an end. And that end is not just higher valuation of becoming a unicorn.
And better version of a bank doesn't always just mean frictionless and digital. And I think to both of your point, we forgot in more ways than others why we're doing what we're doing. We're not here to teach people what it means by embedded banking. Consumers can't
Yeah.
care less. We're not here to tell people, hey, this is open banking and this is how it works. No, to your point, it is a means to an end. All of these are bells and whistles and things we bolt on to get or to hopefully help to get people where they need to be, not about the sausage making, but about the end. Um, what I often found interesting about what you just said earlier about launching quickly reminded me of a survey that I've seen from one of the European fintech. This was a couple of years ago when the Bird app was still a thing. And they published a huge study which got a lot of attention. It was about how many clicks did it take to open an account. And I looked at that, I'm
Yes.
like, so what? You got 5 clicks versus 15 clicks. And this was like their selling point, right? We can open an account faster. And I'm like, well, okay, but okay, I'm going to go open an account. And then what? My goal is not to open an account. My goal is I need a place to save, or I need a place to move my money. I need a place to plan. That is my goal. My goal is not opening an account. It's one of the many steps. And, and that was when I asked, are we even measuring the right thing? Are we focusing on the right thing? And I don't think we were. So the question is, are we now?
I don't think we are yet. I think we'll begin to get there. And if anything, I'm hopeful that the market downturn, and part of that article I said, hey, banks, you got used to this idea of zero rate interest and kind of free deposits, right? That made maintaining NIM pretty easy. That world has gone away. Even with recent rate cuts, right? The free money gravy train for banking is going away. And even if rates do go down, to Ron Shevlin's, big mantra around this cheap motel for deposits, it's our money is going to continue to be scattered in more and more places because there's utility in keeping it there, right? Like, why do I keep money in the Starbucks app? Not because Starbucks is secretly a bank, right? Which I'm sick of hearing about. If we want to call it, maybe it's secretly a payments company, but it's not secretly a bank. But there is value to me having $25 in that account because inevitably I'm in a Starbucks that doesn't have Wi-Fi and my wife is with me and orders the world's most expensive coffee. That is going to go over, the balance. So it's worth it to have money there. Why do I keep money in my Amazon account? Why? Because when I make the trip to the UPS store or Whole Foods to do the Christmas returns later today, I get an instant refund, right? I'm going to keep the money there. It's not going back into my bank account because I know we're going to spend it on Amazon anyway. So banks are going to feel this pressure. There's more private debt capital than ever. And the fintechs got used to this idea of I can always raise more money at a higher price. And VCs were chasing it because, hey, not only is Angela Strange, everything is fintech. Every VC was a fintech VC for a while. And now they're all AI experts, of course. But I think actually the tightening in the market is good because it forces us to actually go do real deep innovation as opposed to this superficial, too many startups that were Me Too's to each other, raising way too much money and chasing and consumers and commercial customers and the bank partners. Everyone was confused at that point, right? There was too much noise. And I'm hopeful that 2025 is a time of deep building.
I sort of like the idea of working to your constraints there. And I think that's why working in the community bank or credit union space always appealed to me for the last, 2.5 decades, because it was all about constraint. There was never 2 pennies to rub together to make anything happen, but you were always being asked to make it so somehow. And, how could you possibly spend $17 billion? I still haven't figured that one out. But that's not making it better. So I would love to see more of those stories on we made do or we made good out of less, and here's how we did it. Those sort of boots on the ground, operator, we made it work somehow stories don't get told enough at all.
Yeah. Well, go ahead, Theo.
I agree. And I think that's why I get attracted to markets outside the US. Because if you look at LATAM, you look at Southeast Asia, those are people with less means, right? Look at India, for example. They have less access to a lot of things. They have to make do with what they have. They have to find ways with using current technology and then piece parts things that work for their ecosystem. And I think those are stories, Barb, to your point, that are not being told enough. And those are stories that we don't hear often enough. Either we don't feel like we need to hear it because, hey, we are right here. We have everything and access to all the resources and innovation and talent, or we just don't care.
Is it we don't care? 'Cause there's especially for you, jarring, pessimistic view, or is it
Realistic,
we
my
have,
friend.
yeah. Is it where we have the latitude to chase the shiny objects because we don't have the constraints, right? Like to Barb's point, I think the constraints are what make us better. And of our own volition, making things better is not the business plan that I think VCs go, oh, let's go fund that. And when you walk into the CFO of your community bank and you say, hey, this will make things better, like there's not a lot of ROI on make things better up until it becomes the means of competition. And I think that's the interesting era we're entering into in a world of constraints is we're going to compete on actually building and delivering real value.
I often wonder if that my competitors are not so much my competitors angle is something that I'd love to see people talk about a little bit more. Saw it a lot in my time in the credit union space, right? Because one of the 7 cooperative principles is cooperatives, helping cooperatives. And maybe because I was only a banker for 2 years here, so I didn't ever really get it. But the idea that it felt like the pursuit always was, if I could just sell more products to this customer, that's us doing better for them. But is it really? Is it really? And is your, version of whatever account actually the one that suits them best? Maybe it's actually not theirs. Maybe it's somebody else's. So I maybe it was just never inside banking long enough to get that, but that one was abjectly confusing to me.
Well, I mean, it's one of the reasons I actually left First Marblehead, the big private student loan company, and part of the genesis of Perk Street was, here we were, and I worked with some wonderful people there, right? And we ran the Chase and the PFC loan portfolios, right? Billions of dollars of private student loans here. And the mission of the company was empowering the educational dreams of America's tomorrow. I can get behind that. I value education, except we kept giving bigger and bigger loans. Why? Because tuition was going up. Parents hadn't saved enough. Parents weren't telling kids no. Everyone knows that education's an investment. And so the right thing would have actually been to say, hey, there is no way the rate of loan growth, the average size of loan that we're giving is not keeping up with real growth in wages, right? Inflation adjusted wages. This is going to become a problem. And, as I would say this around the executive committee, people would be like, yeah, but they want the loan. Like, who are we to say no to giving them the thing that they want? And the reality, I think we all know this now, is right. We have senior citizens that are still paying off their student loans, and the number of students that had to move home, right? Like they're in such an ultra capitalistic society and free market where you say, hey, it might not be in their best interest, but do we still provide it for them?
So let me ask you both a provocative question, or maybe just a question. Didn't mean to be provocative, but I had a recent discussion with someone. Are we innovative in the US? And to which my answer is, well, it depends. I feel like some other markets are more innovative than what we can do because we seem to be repeating what we do. And we seem to tell people this is what you want, even though, to your point, Barb, it might not always be what they want. Because all of this is related to make banking better. Whose perspective is it that we're making banking better? Is it from the perspective of bankers? We're making banking better for them? Is it for the perspective of consumers who aren't even banked to make banking better for them? What's your take? Jason?
Barb, you want to go first? Oh, I have to go first. I think increasing competition will force institutions, whether they be banks, credit unions, non-financial players, startups, to focus on customer centricity and delivery of value is the means of competition.
We didn't have
right?
enough
One of the
competition? You didn't think?
No, I don't. We had a combination of imperfect information, difficulty moving accounts, opening accounts, and frankly, most of it was a little bit the same, right? Like I love Shamir Karkal, formerly of
Mhm.
Simple, and I were on stage talking about this a few years ago at Moves DevCon, and he's like, if you look at, he goes, Perk Street 2008. Simple, launched 2011. And if you fast forward, a decade and a half later, what have we done? You can get your paycheck 2 days early. Like that's the pace of innovation, that we've had over that time period, because there was a whole bunch of Me Tooism and frankly customer laziness, right? There weren't a lot of meaningful alternatives that would give you enough value to say, that's the reason I'm going to go switch.
I think the sameness part is a problem. Like your checking account's the same as my checking account, right? The fact that we live in two different countries with two completely different regulatory regimes doesn't make it lick a difference. Because the one I can get is the same as you could get, and it doesn't do me anything better than yours. Or worse, but not better.
Yeah. But I can, I've got two examples of banks we work with. One is very focused on self-employed, and they're a very large mortgage originator. And what they've realized is, having been self-employed for the last 2 decades, I can tell you what a pain it is to get a mortgage, right? Like I know, Theo, you feel that too. And we even had in our condo in Chicago, our mortgage agent, like at the banks, was like, why don't you just put the whole condo in your wife's name and she gets the mortgage because she's got a W-2. It'll just be easier. Um, we didn't do that, and I regretted it. But this bank looks at it and says, wait a second, we've got a unique competitive advantage because for the self-employed people that we've cracked the code on underwriting for mortgage, there's a whole host of services we can deliver for the self-employed. We have another one of our banks who is actually one of the early partners with Careful, which is one of the Concept Lab graduates, right? And Careful is a platform for adult children to help manage their parents' money, not in a budgeting point of view, but looking for fraud, double payments, mispayments. I'm the power user, right? Like my dad shopping on, Facebook is like, Dad, when did you get a new credit card? I got to take that away. You tell him the communists are coming, he will give you his credit card number over the phone, right? Like it's a tool, and I get these alerts coming through, and they're being very successful with our banks. And one of the banks is leaning in saying, hey, we've got an older population and they trust us. We need to actually not just think about we hold their money, we hold their trust in the trust of the safety of their money. And they're leaning into this around how do we provide more, not just around banking services, but how do we make sure their money is safe and accessible, right? Right. Those are core things and values that, I heard from one of the CFOs, like, how do we know we're going to make money with Careful? And like their chief banking officers, like, we know there are many ways that this will benefit us. And oh, by the way, it turns out if your bank provides something like trust tools, you tend to move all of your banking over to them, right? It's a no-brainer. And it doesn't scale linearly like interest rates, right? Like paying more interest for every dollar, you're going to pay that amount. No, it's a flat software fee. But they're leaning into this idea to say, hey, we're going to be different than that competitor that Barb brought up, right? Like, and who that competitor is. We're going to give them something they can't get elsewhere.
So, okay, this is a good point. Let me dig in there. I'm going to say something. This was the mission that I set out on 10 years ago, right? When you and I met. I've seen so many companies that have come and gone trying to dig into that space. Careful, and I'd say EverSafe is probably the only two that are still around.
Yeah.
Most flamed out, not because of not recognizing the opportunity of specific market segments, is because bankers come back and say, yeah, we don't do old people. I've said that many, many times because I've been told that many, many times. On stage and off stage, we do not do old people. We want to chase after the shiny new toys. We want to chase after back then millennial banking and now Gen Z banking. I lost count of how many people will come to me and say, Theo, let's do something about Gen Z banking. I'm like, no, go away. No, not my thing. I will repeat what I asked half an hour ago. Has anything changed?
Yeah. Well, it's funny you bring up the Gen Z banking piece because that's actually how our partnership with Careful came about. When Chase did the deal with Greenlight, all the banks were like, we got to go do a partnership and do teenage checking. And so we did a deep dive on the area. And here's a couple of the anecdotes that came out from the banks. One bank found that they had more 90-year-olds than 19-year-olds.
Mm-hmm.
Another one of the
Yep.
banks found their number one source of customer attrition is death.
Yep.
Right. And so the realization was, yeah, we can go do teenage banking, but we're going to be dead before they become relevant to us. We
Mm-hmm.
need to lean in. And I would say the thing that confounds what you said, Theo, is also if you ask most community banks, they're going to say, well, we're really more small business focused because that's where the net interest margin comes from. And they forget in a world where, cost of funds is no longer zero, you need deposits, the other side of the balance sheet, to make that small business lending machine work. And it's consumer deposits or small business and nonprofit deposits are really the lowest cost that you get, right? The more sophisticated, the larger the organization, they have sophisticated treasury and they move their money around, right? So you need those accounts. So you need to figure out how I'm going to make banking better for them, right? Like, to quote Alex Johnson, it's not about acquiring customers. You need your customers to want to acquire you, meaning I am choosing to bank with the Bank of Barb because she's doing something, for me and my money that I can't get elsewhere.
Mm-hmm.
Does that need to be we're here for a good time, not a long time, way much more than we perceive banking relationships to be? So I wonder if that's the undercurrent of chasing the youngest generation all the time, because the banking relationship is going to be forever until I die, and that bank is going to exist and outlast me. Maybe that's not just not true. Like you said, are we always just chasing the best rate for a mortgage and we literally don't care where it lives, so just help me acquire it as easily as I can for the situation that I'm in? I feel like we're all way too trapped on this needs to be a forever relationship and monogamous, and that just doesn't make sense at all.
Yeah.
Ooh, that is the first time I've
Yeah.
heard that, Barb, actually. I think
Well,
it's a good question.
I had made this comment on, I don't know if this breaks Theo's rule of this being family friendly, but I had made a comment on another podcast last year about banks don't want to admit that their customers are polyamorous, right? They are not banking exclusively with you, and nor should they probably
Mhm.
bank with you. This to me, and we had this conversation in our strategy and business model center of excellence around the opportunity for community banks in open banking. It's not a competitive threat. If you lean into it, you can actually unlock all sorts of new value where you're not the only relationship they have, but because you can see more of their information, you as their trusted partner can do a lot more for them without actually having to be the one that offers them all of those accounts.
I feel like there's a Venn diagram thing that, leverages that idea of, trusted entity that dives into how do I manage my digital life and the data that, surrounds me. It's not that I keep your gold in my safe anymore. I keep your data and help you manage it in a way that you want to, right? And it's sort of like the game show Survivor and how it evolved. And your alliances are not for the length of the game. It's just, how do we need to vote at this particular vote? Bring that collection of things together for the time that it's relevant, and then move on.
But we need it. I think part of the problem here, Barb, is banks and even fintechs to some degree are so bad at that onboarding, that 15 clicks Theo talked about. And once we get them, we're afraid to let go because the cost of entry was so high. So I want to shove you into more accounts and lock you up forever, not have an easy onboard, easy offboard that's right for you and right for me. That's not the way the banking and fintech business model is built.
And is that because we've made that onboarding between themselves so hard, right? You can't actually afford for your relationships between your so-called quote unquote partners, which they are definitely not, to be transient enough to be transient in the way that your customers want them to be.
And I think it's also how we look at relationship too. Going back to your point, it doesn't need to be the only relationship or monogamous relationship. So thinking back to the concept of super app, right, which we've been talking about for years now. The origin of super app, when we're looking at it, was along the customer life cycle, not just about banking services, but everything else that they do in their daily lives
Yeah.
and how money needs to move from one ecosystem to the other. And you create that highway to make it work easier and more seamless for them. Byproduct of that is you have all the data about that consumer that you want that allow you to use AI and all of these things to make, microloans and everything else easier. Stickiness become an end product of it, not the original goal. Now,
Well, I think we're at an inflection point though there, Theo, right? Where data used to be the byproduct. I think the financial transaction is about to become the byproduct of the data and the data flow. That's where the real value is going to be, is in those bits, bytes, information, embedded transactions, right? Where I don't even think about it as banking. I'm just, right? It's just getting that means in the end are now taking place, in the same location, whether that be in person, right? Like, hey, there's financing, available for my John Deere tractor, right? A buy now, plow later. Don't know where to go with that, right?
No,
Um,
you're right. You're right. But I think that's where the crux of the problem is. Because if you look at some of the banks that we have in the US as well as in the UK, the way they look at Super App is not that. The way they look at Super App is how do I bring my mortgage services, my savings account, my checking and investment, all of these things into one app. But it's all about me. It's all about
yeah.
me from my point of view and not from the customer point of view. So
And
when
that
we
goes back to what I said at the start, right? We're still assuming they want to be in here with us, and they don't.
Yes.
That is a revelation for 2024. How do we move on from here? Prediction 3. Any takers?
We're gonna see an absolute gong show of agents running around, like the whole agentic workforce workflow. I mean, I'm scared to even imagine what plays out there next year, and it's gonna collide down and like the stories that we read this year on bad things happening to people's money and it's trapped and they can't pay their loans or can't pay their medical bills and can't get their groceries because their money is trapped. We're going to see a new series of traps laid there next year for sure.
So much for making banking better.
I wholeheartedly agree. But I think it's pain we have to take, though, Barb, both on the fintech side and on the banking side, because I think we're also going to see a lot more bank consolidation, and not in the way that, unfortunately, a lot of banks out there are thinking, oh, the M&A markets are opening because, regulatory opening. No, you're just going to see the cost of running the bank continues to go up. I think there's going to be a lot of banks and shareholders disappointed with, what they get for that relative to tangible book, except for the ones that have gone and built something unique and different. So I think we're going to see in the M&A, here's my prediction, is there is going to be, this big distribution where there's a lot of transactions that are low price to book, and then there's going to be a small number at the other extreme that are at high premiums because they've built a business. They're probably going to be larger transactions, right? They're not going to be the sub 5 billion. These are going to be, the 10 to 15 billion, but they do something unique. Like they're really good at SBA, or they're really good at payments, right? Or they've built, a tech shop and they understand customers really well. But that's my prediction, is we are going to see more M&A. It's just going to be disappointing for some and exceedingly lucrative for a much smaller number.
So Jason, before I let you go, let me ask you one thing, because this is something that we've been talking on the show for the last 2 years now. To your point earlier about creating customer value, being customer centric, finding things that create, specialty things for people that actually want something. Looking back at, I still love Simple, by the way. I missed that it was gone. But looking back at all the other fintechs, right, that have come and gone, the daylights of the world, that served LGBTQ, some of the other ones that serve, different groups of people. One of the conclusion that someone had told us probably more than a year ago, was that they think by focusing on very specific needs of a certain demographics of people, we are forgetting the fact that even though they are, or quote unquote, labeled by a certain needs, they are not all the same, right? There are a lot of variety to the services that they need, and we forget about that. Do you think that trend will continue, or do we see more banks trying to focus more on the needs of different people in the year coming?
Um, Hopefully those that are good at strategy and not just, the strategic planning portion of it will recognize, right? Like when we focus on, like when we talk about Gen Z, think about what a wide distribution Gen Z is, right? Like pick your average 28-year-old. That could mean I'm single. It could mean I'm married with kids. It could mean I'm divorced already, right? Like it could be early in my career, or I'm just graduating from college, or I'm going back to college, right? Like, so 28 is, back to my monitor consulting days, we would call it action segmentation. And segmentation meaning you don't look at the demographic, what's actually actionable about it, right? Like this was always my problem with Daylight is, oh, we're the, neobank for LGBTQ plus, right? Okay, but what are you doing? What is the unique need other than the identity of that? Right. And I get that, there's some who are like, hey, picking the name on the card is important. Yeah. Okay. That's meaningful. But how big is that as a segment, right? To be able to use the right pronouns and things like that. That's important. But is it deep enough that people will actually, and big enough that people will actually move over? And I think that's where we're going to find the banks that find specialties that say, we're going to do really well at this. And unfortunately, that also comes with the hard choice of I have to quit doing some other things. And banks are really bad at that, right? Because it feels like there's no cost to keeping. Oh, of course, we still have passbook savings. I love making that as a joke in the board and just seeing the facial expression, right? It's like, please tell me you don't still have passbook savings. They're like, well, there's no cost to keeping it. It's like, yeah, there is a cost to keeping it, right? And why do you have 10 versions of a commercial checking account, right? You know, I'm reasonably well versed in banking. When I sit down with Chase and they're always trying to get me to open another account, I'm like, I don't understand which one of these 5 things I should be choosing. You tell me why, right? So I think those that dive deep, and I think it will take the market pressure and increased competition, are the ones that are going to get very customer centric, and the availability of more data is they're going to lean in, and those are going to be the big winners. And I'm very hopeful for 2025 that the banks that come through the other side and the fintechs are going to drive real value. I know we've been saying that for a long time, but it isn't a question of will it happen, is when it happens. And I think increased competition is going to force it.
Barb, we need to bring him back end of 2025 and see how he fares.
We should.
I'll put it in my calendar now.
All right. Yes, we will. Until then, thank you so much for joining us, my friends. We always love to chat with you, and in person or via the screen. So thank you. And for the rest of our listeners, thank you so much for joining Barb and myself for another episode of FinTech Fuse. We will talk to you all next week.